Welcome back to the Money Lab. Seriously, I am absolutely thrilled you're here with us today because week 7, it's a massive, massive milestone in our 52-week challenge. Up until now, we've really been doing the gritty work of diagnosing the problem. We looked at inflation, we saw how purchasing power literally just melts away over time, and we mapped out exactly what we're up against. But today we pivot. We are officially done diagnosing the disease. Today, we start building the ultimate cure. We are constructing your investment engine. Let's get into it.
Okay, let's dive into this, because honestly, it challenges the core conditioning we've all grown up with. Think about it. For practically your entire life, you've been taught to trade your time for money, right? You clock in, you earn an hourly wage or a salary, and then you clock out. But here at the Money Lab, we look at wealth scientifically. And the undeniable scientific truth is that your time is your single most limited resource. You literally can't work 24 hours a day. But you know what can? Your money. We really need to shift your mindset right now, away from that old way of doing things and toward a true scientific investing mindset.
Because working for money, it's like being stuck on a treadmill. You're constantly running, trading precious hours of your life just to keep that belt moving. And the second you stop, the money stops. It's an absolutely exhausting cycle. But owning your investments, now that's like owning a perfectly humming factory that runs around the clock. You transition from being a tired runner on a treadmill to the owner of an engine that just keeps working, whether you're sleeping, on vacation, or just hanging out with your family.
Section 1. The Stock Picker's Fallacy. Now, what's really interesting about this slide is, to get you off that treadmill and into the owner's chair, we have to completely dismantle the gambling mindset. A lot of beginners are terrified of investing because they falsely think they need to be some sort of financial psychic, magically finding the next Amazon before anyone else does. But there's a staggering data point you absolutely need to know. 90%. Just let that sink in for a second. 90% of highly paid professional fund managers, I'm talking people in expensive suits with fancy degrees who are literally paid millions of dollars to do nothing but pick winning stocks, they failed to beat the market average. So if the absolute best in the business fail 9 times out of 10, why on earth would we try to play that same game? The math is clear. It's a loser's game.
So we just don't play it. In the Money Lab, we follow a very specific rule. We don't look for the needle, we just buy the whole haystack. When you use a vehicle like an S&P 500 index fund, you're instantly buying a tiny, perfectly proportional slice of the 500 biggest, most successful companies in America. You're not desperately trying to bet your life savings on one lucky horse. You are safely and methodically betting on the entire track.
Section 2. Mutual funds versus ETFs.
Okay, so knowing we want to buy the whole haystack is great, but how do we actually practically do that? When you open an investment account, you're going to hear 2 terms thrown around all the time: mutual funds and ETFs. Think of mutual funds kind of like a classic car. Sure, they're reliable, and yeah, they got the job done for previous generations. But by today's standards, they're heavy, they can be slow to trade, and worst of all, they carry a massive burden of high management fees. ETFs, or exchange-traded funds, on the other hand, are the sleek, modern, high-performance electric vehicles of the investing world. They're incredibly fast, trading just like regular stocks. They're phenomenally tax-efficient, and they're built specifically to keep your costs as close to zero as humanly possible.
Which brings us to the most important vocabulary term of Week 7, the expense ratio. This is essentially the annual fee charged by investment funds just for the privilege of holding your money. And make no mistake, this fee eats directly into your long-term wealth returns. In the Money Lab, our whole scientific approach relies on ruthlessly hunting down low-cost index ETFs. We want the absolute lowest expense ratio possible. Why? Because every tiny fraction of a percent you pay in fees is money that is no longer compounding for your future.
Just look at this absolutely terrifying math. A seemingly harmless 1% expense ratio over a 30-year investing timeline sounds like nothing, right? Barely a blip. But because of the way compound interest works, paying a 1% fee means you're giving away nearly 1/3 of your total potential wealth over 30 years, 1/3 of your retirement. You are literally handing it over to some guy in a suit to manage a classic car that probably won't even beat the market anyway. Please, whatever you do, do not fall for this.
Section 3. Diversification and chill. So we've dodged the fees and we've chosen the right vehicle. Now we need to talk about our core defensive armor. This is exactly what allows scientific investors to sleep perfectly soundly at night, even when the news is screaming about economic panic. When you buy a broad index ETF, you are instantly wielding the shield of diversification. Because you own hundreds, sometimes even thousands of companies all at once, your money crosses multiple vital sectors: tech, healthcare, energy, consumer goods, you name it. This structural armor protects you entirely from the single company crash.
Think about it. If one specific company has a massive scandal or a CEO makes a terrible mistake and their stock absolutely plummets, it doesn't wipe you out. The hundreds of other successful companies in your portfolio carry the weight. That massive failure? It just becomes a tiny, barely noticeable blip on your wealth radar.
Ultimately, scientific investing isn't about getting rich overnight. It's about capture. You are setting up a machine to capture the unstoppable growth of human innovation. As long as human beings wake up every single day trying to solve problems, invent new technologies, and create value in the world, the global economy is going to grow. And by owning the whole haystack, your investment engine just keeps humming along, silently converting all that global innovation straight into your personal wealth.
Section 4, the expense task, the expense ratio hunt.
All right, so we've built the engine. Now it's time to throw on the coveralls and get your hands dirty. It is time to look under the hood of your own portfolios and see exactly what you are currently driving. So the crucial point is that you follow these 3 exact steps to audit your accounts right now. Step 1, open your 401k portal or your brokerage app right there on your phone. Step 2, find the specific funds you're currently invested in and locate their expense ratio. Now you might have to dig around a bit in the fund details or the prospectus, but trust me, it's in there. Step 3, once you see what you're currently paying, start looking for an S&P 500 or total market index ETF as your ultimate alternative.
Because here is the line in the sand, folks. If you look at your current funds and you see an expense ratio higher than 0.5%, you are caught in the trap. You're paying way too much for those outdated marble and mortar legacy financial institutions we warned you about back in week 5. That is a massive wealth drain. Your lab goal, your absolute target, is to migrate your money into a total market index or an S&P 500 ETF with an expense ratio down near 0.03%. That right there, that is the sweet spot where you actually keep your wealth.
So, once you have that low-cost engine completely built, the only missing ingredient is fuel. Which leads me to a really big question. How exactly does a simple $100 a month reliably turn into $1 million retirement? Well, that is the exact math we're going to unlock in Week 8's lesson on the magic of time. You've got your engine now. Next week, we ignite it. Make sure you hit subscribe so you don't miss it and keep building that investment engine. I will see you back in the lab next week.